With the U.S. stock market entering its 101st month of this bull market, the second longest in history, and with many segments of the market flirting with record highs, it's important to have a perspective on what we're doing and why. Hello, this is Greg Lukin, and I wanted to give you some insight on what's going on in the markets, what we've done in response to what's going on, and how we're positioned going forward so that you have clarity about what we're doing and why. This commentary relates to your managed accounts, the ones held at Pershing that start with XFA or 09S. So with all that's going on in the markets, the economy, and the world, let's put things in perspective beyond the headlines of the day. As you know, we use a disciplined approach that looks at different types of investments available and mathematically evaluates the trends, the strength of those trends, and the risk. That way we can make decisions in an unemotional, mathematical, and factual way. We continue to make some important strategic decisions about where the money is invested and want to help keep you on track. First, let's start with what's happened this year in the U.S. stock market. This is through July 31st, and as the matrix shows, the lines going across are the large, mid-sized, and small-sized companies in the U.S. The columns at the left and right are growth and value, and a combination of those two, what's often referred to as a core, is in the middle. Starting with the large company stocks, you see that in the first months of 2017, the large company growth category has by far been the best performer in this overall view. It's those larger, still those multinational companies that have benefited the most in 2017. And that's good because you may remember that's where our U.S. equity focus has been. The smaller company stocks, particularly those in the value category, have not fared as well. They've come up some in July, but this underperformance is common, and we would expect that late into a bull market or late in the economic cycle. And with August being the 101st month of this bull market, it is quite old. Now moving on to broader world indices. This illustrates more broad-based investments around the world. So starting first with U.S. stocks, we see that the NASDAQ 100, which is that index of the 100 largest companies that trade on the NASDAQ, the companies like Apple, Microsoft, Intel, Google, that has been one of our high conviction areas, and so our portfolios have had and continue to have a relatively high concentration in the NASDAQ. The Dow Jones Industrial Average has been increasing as well. Of course, it now contains Apple, Intel, and Microsoft, three of the major components that are also in the NASDAQ 100. Looking at the next row, we see that developed international markets have done well after several years of struggling performance, and on the far right, bonds have eked out a gain. Despite the interest rate hikes by the Fed this year, bonds are an example of when bad news is being factored in before the announcement of the actual rate hikes. In the middle, we see that emerging markets have done very well, and that's good because that's another area we continue to have a high level of conviction. In fact, some portfolios, not all, but some portfolios have actually increased their exposure to emerging markets. In the bottom row, you see real estate in the form of REITs, positive but very muted so far this year. And we get a lot of questions still about commodities. Some accounts held commodities index fund last year, and that was okay, but we eliminated it from all allocations at the beginning of this year because we didn't want the ballast. That's what our indicators told us to do. They told us to put the emphasis on large company growth stocks in the U.S. and on emerging markets. As far as I can tell, almost everything runs in cycles. We are seeing not so much of the boringness of the summer doldrums. We're seeing plenty of excitement this summer. But this market is old, and we need to be on the lookout for any signs of irrational exuberance that typically signal the end of bull markets. I hope this gives you some insight on how we've been positioned and how we're positioned now. It's our honor to serve you, and we're always glad to hear from you. This is Greg Lukin. All the best.